Hey guys, Freaky Finance here. About a month ago, we looked at ATI physical therapy. Today we're just going through the first week of earnings season. There's a lot of information, how it affects my positions, and just a general macro overview because it's been a pretty volatile time. So one of the themes that I'm expecting for 2022, spending will normalize. So what I mean by that is, you can see my notes here, goods are going to slow and services are going to catch up. So the top chart, goods spending at the top here, it's very high over the trend line. And it has a lot to do with shutdowns and stimulus. And then at the bottom, we see services that still hasn't recovered. And we should see a mean reversion of this. And we are slowly seeing that. Well, goods has actually been pretty resilient. And I think part of that is the variants that are ongoing continue to impact population, whether it's the population itself or the governance of the population, especially in the developed world where there's quite a bit of panic about such things. You can see here that I think services are going to eventually catch up, and demand for goods is going to slow down, specifically probably auto would be an easier one. So a couple companies that I'm going to touch on, and this is mainly just ones that came up this week. So Vertex was one that had good earnings. It's actually been performing very well during this kind of pretty crazy first month of 2022. And again, I view that as starting to see data that Omicron had an effect, slowing down things. And at the same time, you have the Fed who's saying they're going to keep raising rates, and rate hikes actually went from, we ended 2021 with 3 rate hikes expected, and then it started pricing in 3.5 in the middle of January, and then it went to 4, and now it's at 5, or almost 5. The market's basically saying, if you do that, you're going to cause a recession, or that's what it's starting to say. In my mind, this is how I view it. So I'll start with this, a little bit of macro. I'll start with macro and end with macro. I have a view that if I was at the Fed and I had to try to figure out how to slow inflation but also not cause a recession, I would be trying to communicate that I'd be raising rates to get the effect of the expected slowdown as people start reacting to and raising rates, right? You're going to pull back capital that you'd otherwise outlay. So stocks that rely on liquidity should go down, aka the smaller stocks that have less ability to borrow at, say, 2% instead have to borrow at 8%, right? Riskier stocks, right? They get hit pretty hard, especially in the biotech. And we saw that with XBI, so that's something that I look at. And I'll go through a couple things that I look at. But anyway, if I was at the Fed, I'd have to be like, okay, so I'm going to communicate that I'm going to raise rates, then I'm probably going to under raise rates as we go throughout the year. And I think that's going to happen. So I think between now and March, I'm going to slowly be adding. So that's what this beam position is. That's why I'm bringing it up. So I've slowly started adding to a beam position. Timing bottoms is never easy, so you just do it slowly, right? So that's kind of, I just layered into each week. I'm slowly going to add to certain positions. So beam's one that I started adding to. It's actually one that ARK owns, so it's also got punished because it's been affiliated with ARK. But this one over time, maybe I'll do a video on gene editing in general, but this company looks the most promising. It has good partnerships with other gene therapy companies. So I got Vertex for the original CRISPR one. That's going to be the first FDA approved one out of the gate, if I'm correct. But anyway, I got AT&T. I picked up Viacom, just based on Netflix's earnings report as well. And as well as their underlying fundamentals are very cheap, but they're obviously cheap for a reason. I think I did videos on both of them, so I'll link them as well. Spirit Airlines, so again, more recovery plays. So I'm going to talk about, these guys actually didn't report yet, but some of the airlines started to report, and we got a lot of information from credit card data. We'll go through that real quick too. I got a lot of information to go through, so I'm going to go through really quick. Freeport reported. We'll go through that. And then I've started to add to some more services. Again, I think there's going to be a recovery in services spending, and I think these companies are going to do very well, or at least it looks like they've made a lot of good decisions during COVID. And the same thing with Dufry. It's the same idea. Though ultimately, I think international travel will probably be the latest one to go. I've been adding to that one quite a bit. It's my overweight going into the end of COVID, I guess, would be how I view it. Visa, you can see the really all the company credit card have been doing very well. They are still recovering in cross-border travel. They don't believe that the current surge in the pandemic will curtail the recovery. They're not seeing it yet. One of the things, though, and one of the reasons I think the market's reacted like it has during January is that we are seeing a slowdown. You can see that right here. Slowdown in growth terms. So it's still growing, it's just slowing down in rate of change terms. So derivative of growth. Again, you have a natural slowdown in actual data, and then you have the Fed saying they're going to raise rates into it. so it's leading to quite the opportunity, or in my eyes, a slow, steady opportunity between now and until whenever they switch course. T&E, so this is travel and entertainment. This is on Amex. They also blew it out of the water. I don't own Visa or Amex. I don't own the credit card directly. they're also growing quite well. Specifically on, you can see goods and service, so GNS again. You can see they're up 24% versus 2019 levels, but travel and entertainment is down 18% versus 2019 levels. And it gets even more interesting when I go to the international side right here. So when they break it out by region, you can see it's recovered better in the US and recovered weaker internationally. We saw this trend in quite a few things. So when people say, well, the recovery is already priced in, a lot of it is not, in my view, depending where you are on the spectrum. So the goods companies have done quite well, and the services, and especially travel and entertainment, have done very poorly. And we saw this as well during the great financial crisis, when even banks, we saw them get punished quite a bit. It actually lingered. I think Big America lingered at $5 until 2011, even though the crisis was in 2008. And generally, the places where it had hit the most are the slowest to recover, and generally lead to the longest time to get good opportunity to buy more. I'm starting to cycle into these as the trend continues to develop and the numbers technically get better. So, well, a lot of things are going to have hard year-over-year comps. Travel and entertainment's probably going to have some pretty easy year-over-year comps because of the variance that we've seen during 2021. And MasterCard, same idea. They're all blowing out of the water in terms of growth, but rate of change trend is slowing. And this one is just, I just wanted to show that the month to date in January, you can see, yes, it's growing, but it grew 15% versus Q4, it grew 25%, right? So a slowdown again. I'm just trying to get that point across. I usually look at transportation to help me early on, see what I'm expecting for this quarter. They're still doing quite well. It's not even, so automotive's been pulling back quite a bit, though they did have some pretty hard comps in automotive. Grain's been pulling back, which is interesting. And then you have, ultimately, the fuel sources doing quite well. Freeport's a very interesting one. So you get the production that we wanted from Grasberg. It actually happened. And it didn't, there's no issues with it, which is awesome. So this investment's worked out. I still own it, 102% on it. But honestly, at 35, I based on the current cash flow it's giving off, probably worth 50. So, and again, I think long term, like 2030, copper's going to be amazing. So this is one of the companies I want to own. And I think some of these gold companies need to start looking at some copper, or even some other precious metal companies need to start looking at copper in their portfolio going into that cycle. But I think 2022 is going to give me an opportunity in copper, or at least I hope so, because I want to add to copper and slowly rotate out of the energy overweight that I've been having for honestly a year now. Indonesia, so again, this is the main reason why we got into it, is we knew the Grasberg Indonesia, the cost per ounce is very low because of the byproduct of gold. So you can see from a byproduct accounting perspective, it's only cost 18 cents to get a pound of copper out of the ground, and then you can sell it for 4.50. So quite the margin. The main cost, you can see here, royalty is actually pretty high in Indonesia, so the government is definitely aligned with Freeport because they get quite a bit of a cut of the profits. So again, the overall portfolio of the company continues to improve as more copper and gold is pumped out of Indonesia. You can see the annual EBIT estimates going pretty crazy, right? 12 billion to 16 billion based on where copper is. If it's at $4, they'll only do 12 billion. Annual EBITDA, copper's at $5 at 16 billion. I don't know where copper's going in the short term. I know longer term, probably more risk to get into 5. Short term, like ideally, because there is some supply coming on to copper in 2022, is that we could pick up, like say if copper goes to 380, I'm going to look at some other miners that have good production cadences going into 2025, 2026, 2027. I think I talked about it a bit when I did Capstone mining. Anyway, Freeport, $12 billion at copper at 4, right? And the company's currently valued at like 54 billion. So you're getting quite the barely over 4 times EBITDA. And that's at copper at 4. Anyway, though CapEx will be a little bit higher in 2022, so maybe that's what the market's trying to price in. And CapEx spending right now during this inflation means that the CapEx spending is going to be higher than probably what most people are expecting. So you can see that while I am up 100% of the position at Freeport, EBITDA is actually up 160% year over year. So the stock performance has underperformed the EBITDA performance, which is funny. And then net debt's down to 1.4 billion. Net debt's getting very cheap. Balance sheet's getting very good. And so they've started to finally buy back their shares. So one of the things I like is if copper pulls back, they are getting quite a bit of cash flow, even at 380 or 350 in copper if it gets down there. So they'll be buying back quite a bit of shares under this pressure. They did start buying back some. I think their average price was $39 a share. Quite a bit of buybacks, and again, it's based on 50% performance-based payout. So I mean, it's going to be quite good during this next year as well for share buybacks, and that's what I wanted to see. Telecom is a very interesting one. So one of the reasons why I started getting AT&T and Viacom, well, Viacom's different. But they're both connected because AT&T still has HBO. And I'll go into Netflix's details for Viacom. But anyway, one of the things that's happening in wireless, and this kind of threw me off because when I did the AT&T video, I was expecting ARPU to go back up. So this is Rogers. I wanted to contrast the two. So this is Rogers versus AT&T, and you can see this is Q1 2020. So right before COVID hit, or at the end of that quarter, you can see their ARPU for the quarter was $52.85, but then you can see it gets smoked during Q2 by $3. That's not a small move for these guys. A part of that, Rogers has a big roaming book, so this effect is magnified. So basically, when everyone stopped moving around, they weren't getting any roaming charges, so their blended ARPU went down. And you can see it's kind of lagged during 2020 and the early part of 2021, but then it started to recover pretty good. Bell actually recovered before Rogers did, and Rogers has the Shaw that they're picking up, right? They're merging with them. I think that's going to be very lucrative as well. So I actually really like Rogers, though it is one of the reasons why I don't own it is because Rogers is at, say, 16 or 17 times earnings, whereas AT&T's at 8 times earnings. And it still gives off quite a bit of cash flow. That's why I picked up AT&T. But the thing that's surprising to me, this is AT&T's numbers now. You can see during, right when, well, they have the opposite, so they have it on here. So left to right, you can see going into COVID, they're around $50.50. And then you see it get smacked as well, slowly, not as much as Rogers move. But then you get this slow, steady decline in ARPU. And it hasn't stopped slowing. So what happened in the back half in America, they started doing promotions, all three of the big guys, so Verizon, T-Mobile, and AT&T, they started promoting aggressively and lowering, so basically competing on price to get more subs, more people in their wireless network. And you can see the ARPU go down now. They said it should stabilize in 2022, but the market's not that sure yet. So I think eventually it will. International roaming hasn't recovered for AT&T according to them, and they are doing the 5G upsell like all the wireless companies are. So that's exciting to me for the whole industry. I think as more people shift to unlimited data plans, and 5G is more data intensive, I think the ARPUs are going to pick up for the whole industry. But that's just me. One of the things I liked about AT&T, is that HBO, Warner Media, you call it HBO, is doing okay. So they had a step back when they went off from Amazon's partnership in sub count, but you can see they do make quite a bit relative to, say, Disney, which is under $5 in ARPU. They make more than double that on their revenue per user. Netflix finally increased their prices, so I think all these guys are going to slowly increase their prices. I think that's just reflective of the industry. Basically, Netflix, when you start creating your own content, it costs more money. You probably have to raise prices to cover the cost of the content. So I think that's a trend that's likely to continue, but we'll have to see. But anyway, HBO is doing okay. They actually hit their numbers in terms of subs. One of the things that I wanted to point out is that it's doing okay because it's spending quite a bit of money. So it's actually a detractor year over year in terms of EBITDA. So it's spending a lot. And what I mean by a lot, just quantify it. I'll blow this up a little. This is Warner Media segment, and you can see programming cost shoot up to an all-time high. Yeah, that's even before COVID happened. So AT&T's spending quite a bit going into this Discovery deal, which I really like. So this kind of gets me bullish on Discovery shares because AT&T's spending quite a bit going into this launch. And not just in programming costs, you got marketing costs going up more than almost double. And then you have selling and G&A going up 50% in that quarter. So you can see EBITDA gets smacked. You go from, say, 30% EBITDA to 17% EBITDA in the quarter. So you can see one of the reasons why the share price is under pressure. That's when I got excited. Basically, investors don't want to be investors right now. They just want the cash flow. And so I actually think the spending going into Discovery is very good. Ideally, what I'm thinking is buying Discovery as well, because the merged entity will ultimately be the main beneficiary of this, right? Whereas AT&T will only be a 71% beneficiary of these kind of investments in my view. Anyway, so we'll have to see if it sticks, if the churn rate continues to come down or not, for HBO. But I just thought I'd bring that up because it ties into my Viacom thinking, which I actually think subs will accelerate in Q4 for them, just based on their content slate. But again, costs are also increasing, so it'll be fun to see how the market treats. Well, Viacom screen's cheap, spending is about to keep increasing, so it won't be as cheap. So, and we'll have to see how it trades off, because we saw Disney re-rate really high when they had a huge acceleration in sub growth, mainly because they juiced the numbers by India. So we'll have to see what happens once Viacom starts accelerating sub growth. If it re-rates higher, or if it punishes them because it's accelerating sub growth based on higher cost per sub. Well, it'll be interesting to see how the market treats that. Anyway, Vertex is one that just has a steady cash flow of cystic fibrosis. I was surprised when I started adding this. I started adding 200s, and it went all the way down to like 170 during Halloween, and now it's back up to 230 during a period where everything else is selling off. It's very strange, and really, the only thing that's changed is nothing. Basically, the CEO is just sounding more confident, basically saying we're not going to be disrupted in cystic fibrosis, which is their cash cow. Basically, they're a one-trick pony, and they're trying to get to other indications. So, and the first one for them will be CRISPR, which is the one that I'm excited about in terms of gene editing, because I think this is going to be the first real cure for these diseases, and it'll be the first cure for gene editing that's approved by the FDA, or at least that's what I'm thinking. So that should create a bit of buzz in the industry and some more validation. And these ones are pretty crazy because they're easy to see the endpoints, right? Hitting transfusions of blood or not. So I really like Vertex here. And again, the idea was you get the cash cow. So they're up, revenue's up 22%. Margins are really good in drug development. So Louis Vuitton, you can see here. Again, this is just referencing the goods versus services. Well, not really. Louis Vuitton really sells goods, but it tells you what's going on. So you can see wines and spirits and fashion and leather goods doing very well. Luxury in general has been doing very well during the COVID, even against 2019 numbers. Again, I think part of that is the shift on to good spending from service spending. So I'm expecting that to normalize. I do want to bring up selective retailing because that's a read through on my Dufry, right? Not directly because they have Sephora in there and other things, and it's really Asia Pacific focused, whereas Dufry is kind of the opposite. It's more global focused with a little bit in Asia. So anyway, you can see the less bad in Q4. So that's exciting for me. Well, you can't see that. My head's in the way. There you go. Less bad in Q4. So but I'm hoping we see that numbers in Dufry. If not, I know eventually it's going to happen because it hasn't happened yet. On the travel side, this is just JetBlue's. They basically say we're not for Omicron. We believe we would have generated higher revenue this quarter than in the first quarter of 2019. So that's pretty a bullish statement. I mean, if it weren't for this, then this, but it is still bullish. So I think once the variants and this pandemic starts going behind us, in terms of how people respond to it, this should be pretty bullish for airlines, which have suffered quite a bit. And some airlines suffered a lot more. A lot of them had to bridge the gap. So one of the reasons why I haven't bought cruise lines yet is because they had to bridge the gap with such high interest expense. Whereas airlines also did in some cases, but a lot of them issued shares, which again isn't great because you dilute the share base, but you got to bridge that cash flow gap somehow, right? But the reason why I like Dufry is that they borrow at 2% and they're able to get relief on a lot of their leases with the airports. So their position's actually just as strong as it was in 2019. It didn't degrade during this pandemic gap of cash flow. Let's keep going quicker here. Okay, Robinhood, this is a fun one. Just for fun, I just want to bring it up. You can see the net cumulative funded accounts leveled off, so it stopped growing. But importantly, the monthly active users actually decreased, so people are being less active on the platform. It tells you, it's kind of like almost a sentiment check in a way for the really wild investments. I did find this interesting, that assets under custody. Quite a lot of crypto in the Robinhood accounts relative to your overall portfolio. That's almost like, what's that, 10 or 20%, 15%? I don't know. They don't actually have numbers here. They just have the total. All right. They also don't have an X or Y axis. Anyway, you can see the average revenue per user gets slashed in half, so it tells you that people are being less active on the platform. The total revenue is flattened down, so it's not growing. So you can see this thing IPO'd and then it smashed for a reason. It's not just sentiment, it's because of fundamentals as well. And you can see the total revenue. This is really fun. You can see options. They make quite a lot in options, and it's fairly steady. So people trade a lot on options on Robinhood. And look at the margin interest as a percent of their total net revenues. Look how big that is relative to securities lending. So a lot of the people, not only are they in crypto as a large percent of their asset base, they also are a margin for a large percent of their asset base, which is pretty crazy given how volatile these crypto is. Can you imagine? So macro-wise, one of the things that really widened during the back half of 2021 was small caps got smoked, right? We're talking PEs of 14. Not as cheap as China at 9, but you're getting really cheap relative to in the past. So during the Powell pivot, you see it go down to around 12 really quickly. So it could get a little bit cheaper, but I am starting to add to some small caps. Not as cheap as the COVID panic, but I don't expect it to be that cheap. But you never know. Maybe if there's enough negative sentiment, it gets down there. But I'm starting to see some pretty good opportunities in terms of cash flow in small cap, and a lot of small caps aren't giving off cash flow. So the ones that are the worst in terms of need of liquidity have been punished the most. The yield curve started going up. You can see that right here. Again, that's my view, that the market thinks that they don't actually think the Fed's going to raise rates. Sentiment is also one that I look at, and that started to go down, which is another bullish sign for me. It's not as down as I want it, but something to point out. And the equity put call ratio starting to go up, but not enough to get excited yet. So there's some signs that are saying, oh, it's starting to get cheap. And there's other signs saying it could get a little bit cheaper, right? And here's the sentiment, which is really bad. So you can see consumers are really suffering through this inflation period, or at least perceived to be. And then the insider. So this is one of my favorite ones, is I just go back in time and you can see just for the last year, well, there is starting to be more buying. Really, it's more or less selling. And here you gives you a better idea. So what I really want to see is the insiders buy a lot of their shares, because a lot of them are getting cheaper all of a sudden. And that should spike, and that would give me more confidence to buy more and push the button on some of these small caps that have been punished so hard during 2021. So anyway, I'd like to know your thoughts. It's been an exciting week. I got a lot more earnings to go through next week and the next week, but I figured I'd share today because there's just so much information on my mind from this week. So, and I want to look back at this video and see what I'm getting right and what I'm getting wrong, right? We'll have to see if the switch to services from goods actually happens in 2021, or 2022 rather. Thought it would happen in the back half of 2021, but it has not happened yet, but it is still slowly trending that way. Anyway, have a great rest of your week. Oh, I almost forgot. Okay, there's a couple other calls I listened to this week. So American Airlines reported. One of the reasons I look at that one is it's plotted out right here that leisure travel, particularly in the U.S., short haul international, remains very strong, approaching 100% recovery. That's good because that's Spirit Airlines speciality. So I looked through that. They did say Omicron was slow. We saw that in the TSA numbers. I didn't share that here, but TSA numbers have slowed since the new variant showed up. So that's one of the reasons why the airline industry has been filling off quite a bit. And I think one of the reasons why Spirit Airlines has sold off quite a bit. So they are recovering lately, but not back to pre-Omicron levels yet. So Q1 won't be great for the airlines. But yeah, this is pretty strong if that's true. One of the reasons why I wanted to bring up Viacom, or why I showed the Viacom position earlier in the video, is because Netflix reported a further slowdown in subs, and they guided to quite the slowdown in Q1 of just 2.5 million net adds. That'll probably be slower than all the other streaming providers, which is pretty interesting when you're the biggest guy with the most scale. You're going to start growing the slowest. Spencer says they can't figure out why we're not growing as fast as we were pre-COVID. But yeah, and here you can see Reed basically say there's more competition, straight up. There's more competition there's ever been. There's just more people coming at him, so he's slowing down. There's a battle going on right now, and they're aware that they're slowing down because of competition. So again, if I was Netflix, well, their share price isn't as high as it used to be. I was kind of hoping that they'd use their share price to take out one of these other content producers, but that hasn't happened. Which is kind of surprising because you think in a strategy perspective, if you want to protect your moat, you're going to just take out some of the competition through acquisition and increase your content ability, creativity, especially when you're so overvalued versus theirs. Right? So far, the market's punishing Netflix now for growth slowing and sub count. One of the reasons why I like Viacom, obviously, you could say it's cheap, but again, I think expenses are going to come up, so it's not as cheap as it looks. But the thing is, I'm buying it not because I think earnings are going to go up, which is kind of a weird thing to say, but I think the stock's going to re-rate higher on sub growth at some point, and at growth at some point. And right now, it's still priced like a declining cable content maker. So I like the underdog here, and they are accelerating. One of the reasons why I think they're accelerating is because he literally said it December 7th, and they accelerated further than what he thought on their call in Q3. So. And a part of that is the spending, like I said. So they had South Park. They had quite a bit of content. And then Q4, 1883, just the top of my head. Diageo. So again, on the good side, I like to see if there's any good slowing. Liquor hasn't slowed yet. So I am surprised with the growth in Latin America still. You can see Scotch volume is up 20% in the half. Johnny Walker was up 40%. And we have seen Deluxe actually perform better in terms of growth. So again, that's on the luxury side. So people are drinking more at home, and they're drinking more higher priced liqueurs at home. I just thought I'd bring that up for fun because I go through these just to kind of check things out, right, and see what's actually going on. McDonald's, we knew they were raising the price by 6%. They did that. One of the things that surprised me is the labor inflation. It's even more than what I thought. You can see here, our franchises similarly saw inflation, call it in the mid-teens from a labor standpoint. So that's mid-teens raise in wages for the average franchisee. Now, they're still doing very well in cash flow terms. McDonald's is doing well because restaurants are closed. They've claimed that they've taken permanent share from restaurants. Maybe they have. They are doing quite well, McDonald's, and they have put price through inflation already. And I think that trend's just continuing. CPI is finally picking it up. At some point, though, rate of change term inflation is peaking. We saw that the spending on the credit cards are starting to decline in terms of growth, so we should see a decline in terms of rate of change inflation. We'll still see inflation, but it just won't be as high as what's currently being reported. Hopefully that makes sense. And this one as well, North America, residential construction remains strong, elevated housing. So this ties into the copper for Freeport. So this is Caterpillar's. Basically here I'm just saying, okay, is China slowing down because there's quite a lot of copper there? We knew China's slowing down because they're lowering rates, unlike America where we're raising rates into a slowdown. China's actually lowering rates into their slowdown. We'll have to see if this impacts the copper price, which will give me a good entry. That's what I want, right, in the long run, because I'm hoping 2022 gives me an entry into copper. But we'll have to see. So far it's been pretty resolute, and if it gets away from me, I still own Freeport, and if it actually comes down, I'm hopefully to add some nice companies that have a good production cadence going into 2025. So I'm thinking, I think I already talked about it, Tech, Ivanhoe, TRQ, a few Capstone Mining that have some decent production cadence going into 2025. I think that's all I wanted to share. It was just kind of some extra ad bits to add to the last part of that call. But I was like, yeah, I got all these Word documents that I went through too that I might as well show. So anyway, have a great rest of your weekend.